SCHD is once again proving that it's the best dividend growth ETF that exists, and all dividend investors should consider holding it. In this volatile market we've been seeing this year, SCHD has been proving to be dependable in terms of share price and dividend distributions. It's also been doing this while offering the highest yield out of all of its competitors, and it continues to post the best long-term dividend growth. Regardless of whether you prefer dividend growth investing or if you only like the higher yielding investments, there are a lot of great reasons to include an ETF like SCHD in your dividend portfolio. Let's take a look at just how well SCHD's strategy has been doing in 2025 when compared to the S&P 500 and similar dividend growth funds that exist. As I'm currently talking about this, the S&P 500 is down 3.23% for the year, and the Nasdaq is doing worse at negative 5.93%. Despite both major indexes being down for the year, SCHD is currently positive for the year. As of March 19th, the Schwab US Dividend Equity ETF has returned 2.6%, which is a great sign of stability. And that, of course, does not include the dividends being reinvested, which is an essential part of this investment. When we do include the dividends being reinvested back into buying more shares, we can see SCHD is doing even better. A $10,000 investment into this ETF on January 1st would leave you with a total return of 2.82% for the year. Here's a side-by-side comparison of SCHD to the S&P 500. The index has done worse from a total return perspective because the additional shares bought with the dividends have also gone down more. It is still very early in the year considering it's only March, but SCHD has been a much steadier investment up to this point. This is not unusual. When the markets start panicking and selling off, a lot of investors begin to pile their money into dividend stocks. That's because companies that have paid a consistent dividend and have provided growth over a long period of time, by nature, are likely to be much safer investments. Paying a dividend for decades and growing it is an excellent sign of strength for a company. These businesses don't have to pay a dividend, and they not only do so, but they have done so for a long time and they continue to grow it. That's a good sign of confidence, and so people have been buying up these more conservative investments during the market downturn. What I just described are exactly the kind of stocks SCHD holds, and it's why the share price has been stable while the market has been falling. The same thing has been going on with REITs. Although SCHD does not hold REITs, it's why the REIT sector has been up this year. The markets finally realized that most REITs are still doing very, very well and provide solid dividends. With that being said, because this ETF holds more conservative investments, it often underperforms the Nasdaq, which is very tech-heavy during bull markets. Although at many specific times, including so far this year, it does. When the market goes down or is even sideways, then SCHD is very likely to outperform. The key to this fund's success is the index that it tracks, which is called the Dow Jones US Dividend 100 Index. In order for a company to be included in the index, there are a few requirements that it has to have. A stock must have sustained at least 10 consecutive years of dividend payments and have a minimum float-adjusted market capitalization of 500 million USD. So smaller, more speculative companies won't be considered for the index. Plus, each company is required to meet minimum liquidity criteria. They don't really go into a whole lot of detail on this, but basically more liquidity means a greater barrier of safety for a company. The index components are then selected by evaluating the highest dividend-yielding stocks based upon fundamentals-based characteristics. That would include cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Despite including some of the highest yielding stocks, the index excludes real estate investment trusts, master limited partnerships, preferred stocks, and convertibles. The reason for this is to make it more tax-friendly. All of the dividends paid by this ETF are classified as being qualified distributions, which makes it great if you want to hold this inside of a non-retirement account. So to summarize, SCHD picks the highest yielding stocks out there as long as they have 10-year dividend track records, are large in market cap, and have liquidity. If we look at its top holdings, we can see AbbVie, Amgen, and Coca-Cola make up the largest amount of this ETF. Amgen is currently up over 21% just this year. Many of these stocks are also dividend aristocrats, which are companies that have grown their dividends at least once a year for a minimum of 25 years. That's far better than SCHD's bare minimum, which is just 10 years of consistent payments and no yearly increases are required. So how well has Schwab's ETF been performing when compared to similar funds offered by their competitors, including Vanguard and iShares? We'll start by taking a look at the Vanguard Dividend Appreciation ETF, ticker VIG. This dividend fund offers a much lower yield at 1.66% compared to SCHD's 3.76%. But VIG holds more than 3 times as many companies. This is because they have more liberal requirements when it comes to what they'll allow in this fund. But more diversification is usually associated with more safety, and it explains why the yield is lower. We can see, however, that SCHD has crushed it from a total return perspective. VIG has massively underperformed the Schwab ETF while also offering a much lower yield. Let's now compare it to Vanguard's High Dividend Yield ETF, which is ticker VYM. This ETF offers a higher yield than VIG at 2.53%, but again still trails SCHD. When we put it into the dividend reinvestment calculator, we can again see that it's still underperforming SCHD, although much less. This one holds more than both SCHD and VIG, yet it's still not performing as well. Finally, let's compare it to the iShares Dividend ETF, which is called the Core Dividend Growth ETF, ticker DGRO. It yields 2.18% and it holds 407 different stocks, so somewhat similar to VYM. Just like all the others, DGRO is also underperforming SCHD, and the Schwab ETF charges an expense ratio that's 25% less than the iShares fund. Although the outperformance isn't great, it still shows that SCHD has been the better performer. If you extend the dividend reinvestment calculator to further in the past, you'll see the Schwab fund usually outperforms the vast majority of the time when compared to all the other ETFs. This is why I tell everyone who's a dividend investor to hold this ETF. But I'll be honest, if you do have some kind of reason for preferring one of the Vanguard funds or the iShares one, there's really nothing wrong with that as well. Being exposed to an investment that provides this amount of growth is good for anyone who wants to live off dividends someday. But what if you're not interested in dividend growth? Maybe you only like the higher yielding investments, or you're retired already and you just want maximum income. If you prefer income-only investments and you're not retired or even close to retirement, I would still tell you to dedicate at least a small amount of your portfolio to SCHD. When you do start living off dividends, your position in SCHD will ensure that your income helps keep up with inflation. Either that, or you'll have to manually reinvest a certain amount of your dividends to keep growing your income. If you're retired already and you're much older, then the argument can be made that you don't need SCHD and you should instead focus on maximizing income. But judging by my YouTube analytics, the majority of my viewers should consider holding this ETF. So with all that being said, we can see the Schwab US Dividend Equity ETF continues to be the best dividend growth ETF out there, even this year while the market is down. It has the highest yield and offers some of the best dividend growth. It's tax-friendly and it's also diversified enough to be a great investment. Let me know in the comments if you're a fan of SCHD, or let me know if you prefer an alternative to SCHD along with why. After everything we've looked at, I would be genuinely curious as to why someone would prefer VYM or DGRO or something else instead of SCHD. But with that being said, thanks for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.